Today, ladies and gentlemen, the magic of using dividends to retire early. Today, we're breaking down my entire plan and how you can do this as well. So let's jump right into this. Welcome back, passive income investors alike. Today, I'm reminding you and myself on my financial independent retire early journey plan here using dividends and dividend stocks to help grow passive income while I sleep to make money. I am not here to brag. I am not here to gloat or be overly arrogant or anything of that nature. I'm just here to show you my own personal journey to an early retirement and also show you how to make money while you sleep. None of this is easy. A lot of this took years, but every day I always feel like my back is against the wall and I am trekking forward, trying to get everything going. But sometimes I have to step back, take a breath, look at my long-term plan and realize, things are going to be okay. Now, let's just jump into this, starting with my dividends have reached all-time highs. This is going to change because I'm going to be restructuring my six-figure stock portfolio, which we're going to look at in a second to show you what's going on, where it currently sits at. But right now, this is not that bad. I'm doing quite well on the dividend income. If you're new to this channel, don't worry. I'm going to show you how much money it takes to get these kind of dividend yields. But more importantly, why dividends? Why dividends over anything else? Now, a lot of people are going to pressure you into saying real estate's the best option, maybe online businesses, maybe anything other than dividends themselves. But why I like dividends the most is they're easy to buy. You can collect the money no matter where you are in the world, and it essentially will fast track you into an early retirement. And I want to show you how exactly that works by looking at a compound calculator. So let's just head over to my computer. We're going to analyze my entire positions, how I'm going to rechange the management of them to basically put myself in a more balanced position, and how hopefully you can do something similar yourself at home. Now, just remember, you guys are looking at me 6 years later. If we jump back 10 years, I was $20,000 in debt, had to hustle like everybody else, living in my mom's basement where I continue to live, unfortunately, but we're getting there. And then essentially what I did was I learned about investing, started saving, and 6 years later, I've been able to bank a six-figure dividend stock portfolio with capital gains and by adding roughly $10,000 to $15,000 a year. So let's just start talking about the long-term plan and how it's looking for me. So come on, guys, check her out. All right, ladies and gentlemen, I want to show you how I'm going to take this $113,000 portfolio, including my other RBC portfolio that has $1,000 in it, bringing me to a total of $114,000, and simply using this compound calculator to remind myself at where I'm going to be at 5 to 10 years from now. And this is what is wonderful about dividend investing, because once this system is in place, it is a self-sufficient passive income generating machine, and there is nothing better than this, though people will argue real estate, it has its ups and downs. They will argue starting businesses, which has its ups and downs. But the only thing that doesn't have ups and downs, guys, as much as people like to think the stock market does, you don't have to worry about it. You just set it and you forget it. And it all starts right with this compound calculator. Presuming I'm going to be able to continue to add $500 a month minimum at the bare minimum, we're looking at about $6,000 contribution a year. And then on top of that, let's just say I don't want to retire in my 40s or 50s. I want to try and get a nice healthy income coming in to cover most of my bills by the time I'm in my mid 30s to late 30s. So let's just take a look at the first 5 years out, all right? Presuming that even with my dividends at around 4 to 5%, if I can get a little bit of equity growth, so say my stocks, just the base value of the stocks tend to grow, and I'm able to make 3%. So 5% off the dividends, 3% in growth. Let's say we're making a market average of 8%. Starting with my $114,000, that's going to bring us to, in the next 5 years, somewhere around $200,000. This is what I'm using as a baseline to keep myself on track to see where I'm going on my financial independent retire early journey. But I'm only 27, so that would put me at 32. So let's say we look at 10 years out, that would put me directly in my 37, right between 35 and 40, which would, boom, give me $340,000. Again, this is presuming I can come up with about $120 a week to constantly invest into dividends. And then at that point, if I can sustain a 4 to 5% rate of return off the dividends, we're going to be looking at a really healthy $15,000 to $20,000 in a drip, my dividend drip that would come in on a quarterly and monthly basis to help sustain those bills. Now, obviously, that isn't enough to retire on, but damn, that would cover mortgage payment, that would cover basic rent. It would basically basically keep the fundamentals of your life functioning if everything else falls apart. Now, obviously, this takes a lot of work, and it's taken me a hell of a lot of work to get to 114,000, and to try and help myself balance out my positions here in basically my three portfolios. I just quickly want to go over with what I'm going to end up doing with this as I see it today, because I'm not happy with the way this portfolio is performing or the way it is set up. Now, mind you, it is performing, my TFSA is performing incredibly well this year, but what I want to do is get this in a situation where I can just set it and forget it. Because my positions are a little out of whack, I essentially want to use $10,000 as the baseline now for any investment I make. $10,000 pretty much ensures you have enough skin in the game that if these companies do really well, you're going to do well with them. And it's also enough that, if the stock drops 30, 40, 50%, it's not going to annihilate me either. So what I plan on doing is I'm going to be leveraging down in Bank of Nova Scotia, Canadian Imperial Bank, and Northland Power, which is going to hurt the most. I'll probably do this one last. But when these banks just pop up a little bit again, I'm going to take out basically the amount that will bring me down to a self-contributed amount of $10,000. And then what I'm going to do is scale up all of these positions so they're all at level. Because I've learned this year, me picking individual stocks, it doesn't seem to matter what ones are going to do well and what ones are going to do worse. It's kind of hard to predict. So instead, I just want to pick my favorite stocks and get them all to a baseline, set them, forget them, and then move on to the next one, baby, and keep growing the portfolio. So obviously, in the US amount, we're talking about Canadian dollars here because these are positions in US and my US positioned account. I'm only going to be adding the amount that is the equivalent to 10,000 Canadian. So these are Canadian dollars, which is basically would bring me down to like 8,000, 9,000 US. So I mean, these positions are going to look a little different if you're looking from the US perspective. So these positions, to get them to 10,000, I'd have to roughly add $7,400. So most of them are already finished, obviously. Like Altria Group only needs another $600 to take it to roughly 75. British American Tobacco only needs another 15, or actually a little more than 15, give or take. We're only at 5, so I'd have to actually add about 2,500. Apple's pretty much done. I got to add another G Note there. Microsoft, just another G Note or 1,500. It's really not that bad, and because I'm going to be able to contribute another $6,000 at the beginning of next year, so 3 months from now I'll be able to pop in a bit of extra money in here. It's going to allow me to pretty much fully level these positions off. Minus, obviously, I'm not going to have enough to pump into GEO Group or Southern Company to finish them off, but they're damn well getting bloody well close, and I'll probably use some of the dividends to finish them off. And that way I can completely forget about worrying about these positions being over leveraged in something like Canadian Imperial Bank that's been doing horribly so far in the short term. And that way I can just be happy with the way they are because I will see it as being finished. It's hard to imagine, when you're doing this, what it actually feels like to be done something, because you can scale these positions in any way you want. Some obviously investors are playing day trends, things of that nature, and for them to be happy with what they're doing is a whole different structure than what I'm trying to do. So overall, guys, that would give this portfolio a nice balanced income as it's a tax-free savings account. It would allow me to collect that drip, those dividends tax-free, baby. Moving into this account, though, the managed account, where I'm going to have to really do a lot of structuring over the next 3 months to get myself happy so I don't have to pay a whole lot of tax. And the way we avoid paying taxes in a managed account is, well, there's not a lot of ways to get around it. I could take all of these losses because this account looks like it's doing terribly, but they're all brand new positions. They're not really moving a whole lot because we're only like 6 months into looking at these positions, though I do think MO and BTI are going to come back with a vengeance in a short period of time. I'm going to end up transferring many of these positions into my tax-free, or my RSP, I was going to say tax-free savings account again, but my RSP account, which is a registered retirement savings plan, which can't really draw huge amounts of money off this without paying crazy penalties and taxes. But today it's going to save me $6,000 to $10,000 in paying tax. And then what I could do is set these up in safe Vanguard index funds and use the drips that come off this, that if I need the dividends, I can pull against them and then use them in smaller amounts, because you can only withdraw $5,000 from this account, but without paying any huge tax implications. Like, I think the minimum is a 10% withholding tax on $5,000. So anything up to $5,000, you're not paying a huge amount of tax on if you're just using capital gains. You do not want to put money in this account and to pull it out in huge chunks. You don't want to do it right away. This is the long-term retirement account, and it'll be the only time I fund this account. Once this account is funded this year, I am done with it, because the money that I put into these stocks was from gold that I sold that was just rotting in the basement anyways, and I'd rather get the dividend
and the exposure to the indexes. So I am going to be leveraging these down. In this account, though, I do plan on keeping Tesla and some of these positions once I finish balancing it. But I just want to see where these positions go. Just hold on to them for the next month or two and then slowly start leveling them off. I might sell J&J off sooner just to stick it into my tax or my RRSP account just to do that now and get it start ripping off the band-aids. And like I said, it's not going to be all of this money. It's just going to be enough to balance my taxes out. So I only end up owing a couple thousand at most instead of paying a huge chunk of 6,000 to 10,000 with the rest of the income that I make this year. And then once I'm done doing that, like I said this year, guys, I am done funding that RSP account. Everything else moving into 2020 is all going to be for basically dividend focused. I'm just going to put the tax money aside, pay it quarterly, and forget about it so I can focus on building this income and the sustainability of these portfolios overall. Now, like I said, with the RSP account, you got to be a little careful to avoid paying any of those major penalties because I do plan on withdrawing the dividends out of this at some point. And like I said, if you have to pay the 10% tax on the dividends, that is, again, just the initial upfront tax. Then you also have to pay basic income tax where they look at your basic income for the year and that'll get tacked on as basic income. But at the same time, you're not paying that huge tax today, so that money you're saving on taxes is going to generate you income, which you can pay later down the road by just drawing out little amounts at a time if you need it. You do not want to take out huge amounts of money out of this account. And that's why I'm trying to buy basic index funds to keep this sustainable. And heck, even one day, if I decide to buy real estate, I could use this money. But in the meantime, it's going to be tax advantaged and it's going to be protected. And that's the main goal behind all of this. So other than that, if we want to take a quick peek at the dividends, guys, we can see this is the bread and butter of these accounts. In this account, I'm bringing in a nice, my tax-free savings account. These are all tax-free income, by the way, except don't forget on U.S. holdings, you pay, I think it is, don't quote me on this, it's something like 15% withholding tax, over the border tax. But I don't mind paying that because the yields on some of these companies are so high, it balances it out. And I'd rather have the U.S. income over the Canadian income because U.S. income is just better. I don't trust the Canadian dollar that much. So I want to limit my exposure to roughly 30 to 40% Canadian and the rest in U.S. just to give myself a nice balance on my income and protect it against the Canadian economy, which I don't trust as much as I trust the U.S. economy, just so I can have that exposure to companies like Apple and Microsoft. If you guys want to know more about dividends, I will be making specific videos on my dividend income between my four accounts. But today I just wanted to give you an overall look at my entire financial independent retire early plan and the basic structure behind it. Now, obviously with this compound calculator, it'd be nice if we could sustain adding more than, let's just say we end up adding $1,000 a month. If we can get to that point and we're adding, say, $12,000 a year, well, that drastically changes everything and would really fast track my entire financial independent retire early journey over the next 10 years. So, I mean, it's going to be fun to see how all this pans out, and I hope you guys will stick around for it. So I hope you enjoyed this quick breakdown.
Slap a like and consider subscribing. I talk about finance and dividend stocks and my own personal financial independent retire early journey here on YouTube on a weekly basis. I monitor and update it and keep you guys posted as much as possible on my income and everything else in between to hopefully teach you something. And I got a lot of plans coming up, guys, a lot of cool plans, a lot of cool stuff, and I'm going to be restructuring my YouTube channel over the next 2 months. I've just been slamming content out just to get myself in a position where you guys get a lot to learn from. So stay cool, stay awesome. I look forward to chatting to you real soon.